Well, this is Michael Douville, and it is June 12th. We're talking about liquidity. We're talking about the timing model. We're talking about safety in the marketplace and when the recovery is going to take place. This is regarding a lot to the webinar that we had last Tuesday, the 9th. And we talked about the fact that, yes, the economy looks like it probably is trying to recover. I haven't personally seen where we've had a lot of green shoots. Of course, we've had the economy across the country open up, and of course you're going to get a huge pop in employment data because people are going back to work. So if you go to 0 to 50%, that's a 50% gain. That is historic. That's a wonderful beginning, but we're still 50% down. So we have a long ways to go, but once it starts, it's going to start, and I think we're probably going to start pretty quick. If we haven't already started now, we're going to start pretty quick. I'm thinking that by the end of July or first part of August, we're really going to be able to see the fact that we have made a corner. It's going to be the end of the recession. I think it's going to be probably one of the shortest recessions on record. It was vicious, certainly, fast. I think it was probably the fastest recession we've ever had, but it's probably going to be also one of the shortest we've ever had. Now we're going to start, we are looking for things to start working. We want to start seeing more and more people keep coming to work. We want to see that the economy is moving in the right direction, and that will be a virtuous cycle. I fully expect to get that. I do believe that we've bottomed on a recession and that we are on our way out. Now that is a really, really long ways from recovered. This was a very, very vicious recession, and it's going to take a little while for this to work its way out. A lot of jobs are never going to come back. A lot of companies will never come back. A lot of companies that really shouldn't have been in business are not going to come back. You know, the zombie companies that were supported by very easy money, those probably will never come back. So there's going to be a lot of changes in our economy. This is just an absolute for sure. But what I will tell you is that in our asset class, in the real estate industry, that is a basic need. It is a basic commodity. It's shelter. Virtually everyone needs a place to live. And of course, that means that this is a very, very conservative asset in a very conservative asset class. And of course, our business is going to continue. Now, here's what I'm expecting is that we're going to start seeing higher prices as we go along. I think in 4 years from now, we're going to have extremely higher prices from what we have now. And it's going to breed opportunity for you to which to buy a house or buy multiple houses if you can. Now, I've been asked a couple times if I think this is not a good time to buy. Well, I think it has risk in the marketplace in that, of course, anything can happen. You know, we have timing models, we have predictions, but of course, if we have a total economic collapse or a Mad Max event, or we have war or something that certainly is going to throw off our timing models, and we still have risk in the marketplace. We're having turmoil in the streets, and of course, a lot of that has to do with the lockdown. We have to really get drill right down. I mean, people have been locked down in place for 30, 60, 90 days. I mean, a lot of anger over that. So that's just being expressed and a lot of people not working. So this has not been a very good economic scenario anyway. But let's get back to like the 6 great markets in the United States that probably are going to continue growing. And after the recession starts and recovery starts, why these markets are really, really going to do very, very well. If you maintain that cash flow form that we've handed out and that you have if you buy property or investment that works very well in that, and it fits in the model and it fits in your parameters, then why, for all means, I would say go right ahead and do that. I would just want to make sure that you've got enough safety in it. But if you're getting your cash flow and you're not jeopardizing the asset, well then by all means go ahead and buy that, because I think once we start going in 6 to 12 months, you're really going to see a difference in the economy. I think the economy is going to look vastly different in 6 to 12 months. It's going to look so much better. And then in 24 months, I think we're really, really going to look strong. So sure, this is when you want to buy those properties. This is when you want to pick up those properties while it's kind of dicey. If you've got people who have turmoil, have a little bit of questions, they think that the economy isn't as good, this is a perfect time to buy these properties. Just be very careful to make sure that they fit in within the cash flow model. If they fit within the cash flow model, by all means, go right ahead and do that. And this leads me to the fact that for interest rates, most of our properties we hold for a very, very long time. We're going to be looking at that 23, 24 timeframe to sell some of our properties, but we may not sell all of them. And we'd like to make sure that we have fixed rate long-term mortgages and fully amortized mortgages on all the properties that we buy if you're going to leverage. So please do that. And I think that we're going to have volatility in interest rates. Now, the Federal Reserve came out this week and said that they are going to support mortgage-backed securities, the MBSs, to the tune of $40 billion a month. Now, that should be adequate. But of course, we also need the private markets to come in with another $40 billion a month because we run between $80 and $100 billion a month in mortgages. So if you have the Federal Reserve backstopping the mortgage-backed securities, it's going to keep interest rates from rising. And of course, I think that the Federal Reserve and the U.S. government and the Treasury are going to do everything they possibly can to keep rates low. However, there are going to be some market forces that are going to be pushing it back, and we did see that interest rates broke their long-term trend line. So there's caution out there. Be careful what you do. And I'm here in Phoenix. You guys have my Scottsdale number. You're welcome to call me, and we can discuss anything that you've got going. So my very, very best to you. Bye-bye now.